Hey ladies and gents, Jed Bratt here with the Real Estate Jedi of Big Block Realty. In this video, we are bringing you the month of August 2019 San Diego County real estate market update. As always, we're going to talk about the latest in San Diego County housing numbers. We're going to look a little bit at interest rates and see what the Fed's been doing. And we're going to talk about some other things that might be good information for you if you're thinking about buying or selling in today's market. And if you haven't already, be sure to subscribe to the Real Estate Jedi YouTube channel and make sure you hit the little bell to be the first to know about these videos as soon as they come out. And if you find value in this, would you please go ahead and click the little like button and leave a comment below and let us know what you liked about this video, or if there's anything else you'd like to see in the future. We'd love to have great ideas from people like you as far as what else to make content on. So as always, thank you for watching, and let's go ahead and get started. So starting off, we're as always looking at active listings in San Diego County. We are looking at detached houses as well as twin homes, townhomes, and all other attached. So the traditional bread butter residential units in San Diego. We're not restricting it otherwise. Right now we're looking at active listings. So this is our inventory, active inventory that buyers have to choose from. You can see we're down 6% year over year. So we're hovering right around 7,000 active listings as of end of July. New listings coming on the market is down 7.1% year over year. So again, that's indicative of shrinking inventory further. Pending sales are up 10.9%, which kind of goes hand in hand with the shrinking inventory. More properties are going off the market and pending, getting under contract, and then turning into sold listings. And of course, typically speaking, pending listings are going to sort of precede what we can expect the following month with sold listings. So if you look here, we're up 1% year over year for sold listings, but if we look at pending, we're up 10%. And you can see here, May, these are the high months for pending. And then we come here and look at the same months, June. So of course, high pending sales in one month typically more or less leads to higher closed sales the following month, being that most escrows in San Diego are 21 to 30 day time frame. Many times it's going to be indicative of the following month of production. If we look at dollar volume just for reference, pretty similar to where we were the same time last year. And then if we just take a look at, let's see, market time. Let's just look at all the main analytics right now. Market time, this is active market time. Average is 31 days across San Diego County. This is across all property types. So this is sort of a very broad stance. I'd actually look at median rather. 18 is going to be a bit more accurately indicative of sort of what to expect with an average property sitting on the market. Active market time, again, let's just look at median. It's going to be similar to, I was looking at market time total. This is active market time. So this is the time the property is actually sitting actively listed on the MLS. 14 days, that's 7.7% up year over year. So a little bit more time on the market active than we were last year. Months of inventory, we're going to look at actual here, pretty flat from where we were the same time last year. And that's about 2.6 months worth of inventory. If no more houses were to come on the market and everything that was sitting on the market currently was just to be sold off over the following few months, we would last about 2.6 months. Median sales price across San Diego County is sitting at $585,000, and that is entirely flat. As we can see, year over year, we are actually about the same end of last July in 2018. So, if we were to average this out a bit further, looking at rolling 12 months, you can see we've kind of been flatlining over the last few months here. And this is just averaging every data point with the preceding 12 months. Now, if we are going to, let's go ahead and look at interest rates, all right? So, as you guys may have seen all over the news or in some of our blasts or elsewhere, the Fed decided to drop the target interest rates one more time. So, not one more time, I'm sorry, for the first time actually since the last recession. Now, you're not going to see it here because this is the effective funds rate. Now, if I showed you the target funds rate, you would see a little dip here because they changed the target federal funds rate from 2.25 to 2.5% down to 2.0 to 2.25%. So they dropped it by 25 basis points, which just basically means that they are setting a goal, a target to bring those rates down by about 1/4 of a point. And we've talked about this many times in past videos. It doesn't necessarily mean that they're going to immediately have an impact on mortgage rates, for example, across the board, but nonetheless, typically speaking, it is going to be influenced down the road when the Fed drops their federal funds rate. Now, if we look at interest rates here, we did definitely see interest rates even come down further. So we're, as of August 15th, around 3.6%. This is for the average 30-year fixed rate mortgage in the United States. So this is just a rough ballpark to kind of place the movement of interest rates over the last several years or decades. And as you can see, this is about the lowest we've been since, let's see when specifically. Last time we were this low, we got close in September 2017, but really for the most part, we're looking back in 2016, about November 2016, when we were in the just about near 3.6. So we're definitely sitting at some of the lowest rates we've seen in quite some time. We know that we spiked up end of last year pretty significantly. That put the brakes on the market here in San Diego, as we've talked about many times in the past, in past videos. So what's that ultimately mean for San Diego real estate? Well, it's going to be kind of interesting to see how this plays out in the coming months and years. Yesterday, also, just to mention the Treasury bonds yield curve inverted. So we've talked about this many times as well. The short-term yields, or rather the long-term yields, dipping below the short-term yields. And we've had the inversion of the 3-month, we've had the inversion of the 1 year to 10 year, and now the more traditional, better known benchmark is the 10 year to the 2 year, and that mildly inverted for a split second yesterday. And that's been across the news headlines as a flashing red light, basically signaling recession, typically speaking, in the following 12 to 24 months. Historically speaking, every time we have had an inverted yield curve between the 2 year and the 10 year, then there's often been a recession in the following 12 to 24 months. Now, that said, there's always the chance that things could be different. So what are some things that are different? Well, it's certainly interesting that we are so low on interest rates and we're talking about a potential recession coming up. Because historically speaking, we usually the Fed drops interest rates 2 to 4% upon entering a recession, because they do this to sort of absorb the lack in demand, the slow growth, the holdbacks in the economy, and sort of to stimulate and light a fire under everything again. And if we are already so low, we've talked about this as well. I don't mean to be repetitive, but where are we going to go if we're already so low? Because this is, mind you, this is not the federal funds rate. This is the federal funds rate, okay? 2.4%. And actually, I think their target right now is 2.0 to 2.25. So where they want to be is actually closer to around here. And like I said, historically speaking, we drop rates 2 to 4% upon entering a recession. So if we're already at 2%, where are we going to go? And this is the interesting thing to see. We've brought this up a number of times. The prospect of going down much further in interest rates, possibly even negative interest rates. And if we look at this, we look at central banks in other countries, we can see that we are not particularly high. We're not particularly low. There's several countries that hold their Fed funds rate much lower than us. Australia, South Korea, Europe, Canada, Denmark. Some of the most notable examples of extremely low interest rates, though, for long periods of time is Japan. And Japan has had actually negative interest rates. I'm highlighting the wrong parts here. I'm sorry. I'm meaning to look at this. Japan has had actually negative interest rates for a great number of years now. And blowing people's minds and economists' minds, they've actually managed to still have a positive growth in their economy despite this very odd phenomenon. And they're not the only ones. Sweden has also had this. What's interesting about this, though, is we've never gone below 0% rate. Now, we did sort of maintain effectively zero for a great deal after the last recession. But if we were to go zero or sub-zero, that's going to be uncharted territory, relatively speaking, for the U.S. And how people will react to that is going to be interesting to see. But if we look at the, if we look at like what Japan has here, what's really crazy is Japan has 35-year fixed rates for mortgages. So if you want to buy a house in Japan, 30 years more common out here. They have 35 years. And their 35-year fixed rates average has been 1.23% for the last whatever recorded period of time. 1.23% for a fixed 35-year fixed rate mortgage. How crazy is that? So to think that we are potentially going to be in that sort of scenario, not necessarily 1% rates, but where are we going to go if the Fed feels that we must drop rates drastically further, much more so than these 25 basis points, just as like a precautionary action against having to drop them drastically later on without having given any stimulus to the economy beforehand to try to neutralize any threats. That could certainly put us in a very interesting place for interest rates. So what I did here is I just plugged in some numbers into a chart here. So in quarter one of 2018, we kind of knew that the market was slowing down in the last half of 2018, right? So I just kind of charted up interest rates and the median price at the time and the principal and interest payment for that period of time, and then ranked them according to color as well. So you can see green is going to be the lowest for price, interest rate, and total principal and interest payment. So first quarter 2018, 543 median price, principal interest payment 2681. We know that interest rates started climbing up quite a bit higher. They actually got very, very close to 5%. This is just the average rate for that quarter. And at 583, we had a high payment of 2978, right? And again, this is just for reference, just as a general ballpark to kind of show where the payments were going and what buyers are sort of feeling as the market was being affected by these interest rates. They halted the drastic high interest rates at the end of 2018 because there was immediate pushback from the economy. You could see there was a lot of slowing in a lot of sectors and a lot of real estate markets across the country, especially we felt it, I know, in San Diego. You could see the median price drop down a little bit. Now, median price also does go in seasonal cycles, more or less. It'll vary. Technically speaking, you're going to have the highest upward pressure on prices during the hottest selling season, so in the summer. And in the end of the year, you're typically going to, maybe have a little bit of cooling in prices, but it's not going to be very drastic. This was pretty significant. And then we started coming down in rates, and bam, prices are jumping back up again. So starting at the beginning of this year, we really felt getting back into the swing of things, and there's been multiple offer situations on, I'd say a good 50, 60, 70% of properties, depending on where you're at in San Diego County right now. So there's been a lot of activity in the market this year so far. And of course, right now we're at 3.71% interest rate. Actually, if we look at that chart we just looked at, actually we're closer to 3.6, but this is just the average for the last few months. So even though the market feels incredibly healthy and hot right now, we just need to keep in mind that, of course, this is all being stimulated by these interest rates. On the other hand, if we were to think that, for example, rates were going to go up drastically in the next 6 months, then this would be something to be a bit more cautious about. But if we're looking at the current demand for housing, the shortage of housing, the very likely projected course of interest rates in the coming months or couple years, especially considering the likelihood of a recession. And recessions don't directly always affect real estate. They do not have to. Real estate can continue to go up while a recession might affect equities, stocks, and those might continue to come down. Sometimes they go hand in hand like we saw in the Great Recession, but it all comes down to, of course, what's causing the recession and what are the underlying fundamentals. So if we were to think that interest rates might continue to come down to sort of continue to prop up the economy and follow the course that, for example, Japan has followed and proven to not be insanely detrimental as much as many people predicted over a short period of time. I'm not saying that over a long period of time, I'm not saying that Japan is, an envied economy right now, but nonetheless, they've held their own to some extent much better than you would think if they're in the negative rate territory that they've been in. So I just put in some hypotheticals here, okay? So you could see as soon as we start coming down in interest rates, even though we have a higher price here, buyers are feeling almost as good as they were when we had a higher interest rate and had a lower median price. Because this payment is really more or less what buyers are buying, right? If you're going to buy a car, you're not so much as worried about the price tag as you are the payment. And even more so with houses, because most of the time you're not really thinking about that last payment you're going to make. You're really just thinking, how long can I continue to make these monthly payments? So if we were just to say hypothetically, what if rates came down to 3.5% and prices continued to climb to 625? Okay, we'd be at about a $2,800 payment. Still, not a great deal higher than where we currently are. Let's say rates continue to come down 3% and we went up to 650 on a median sales price. Look at this, 2,740. This is actually lower. Look at this. We go up 25,000 and you're still lower in payment. What if we go down to 2.5? And I know this is crazy, right? 2.5%. I'll tell you what, I had a fixed 2.75% 30-year fixed rate. Just a couple of years ago when we last had our interest rate lows. That's crazy, right? 2.75. I didn't pay any points for that. So 2.5 may or may not actually be as far off as you think. And this is just hypothesizing. So let's say 2.5% we get down to, and the price, that still gives room for prices to even go up to, look at this, 675, and look at this. This is even more comfortable for buyers than we were at 625 and 3.5. In fact, it's almost as comfortable. Actually, it's less so. Look at this. Then at 543 at 4.28%. And mind you, 4.28%, 4% rate is not bad. 3%, 3.5% is amazing. I'm not saying that we're going to get this, but if we do, and if that's the way that rates continue to keep going, based on what experts are foreseeing with the global economy, our national economy, and in the current trajectory as far as growth goes, lower interest rates in the twos very well might be something that's coming up. And it just sounds crazy to say because it wasn't that long ago, everybody was saying that rates were going to go up and up and up and up. And they certainly were. But this is where we are currently looking at as far as the projection for rates. So who knows? That's just, that's my 2 cents. I don't know if this is really going to happen or not, but if nothing else, it kind of gives you a little food for thought as far as, okay, well, is the market getting ready to top out? Even if, if the national market went into a recession, then, and I'm not talking about real estate, but if we had 2 consecutive quarters of negative GDP growth, then what would the likely case be for interest rates? So they're probably going to go down, and that could very much possibly positively affect California real estate. So anyway, not trying to ramble here, but nonetheless, something very interesting to keep in mind. Disregard this one for right now, and then I was just going to show you. I mean, this is just historically speaking, as far as interest rates go in the recent few years, going back to 2014. Blue is interest rate, and the yellow is median sales price. And you can see they're not always directly related. Sometimes rates go up and prices go up. Sometimes rates go down and prices go down or stay level. But you can certainly see that as we were getting to highs that we had not seen in almost 10 years, we certainly felt that in the price very drastically. And then they very quickly withdrew that and started pulling back on those increases. And it's kind of let prices and competition again go a bit more in the direction that we were seeing not too long ago. So anyway, a little bit of food for thought, something to keep in mind. Now, one more thing is I just took a snippet from the Wall Street Journal the other day, and it's just talking about how debt is still definitely growing in middle class. And we can see that in, leading up to the last recession, housing debt was the hugest. That was the largest amount of debt that consumers carried. That obviously collapsed. We had a debt bubble through the housing market. And now we've been seeing non-housing debts climbing much higher. And we can see that student loans are, of course, one of the very leading causes of that. Not so much credit card. That's been more or less flat. Auto loans have definitely been creeping up, but student loan is really what's kind of continuing to hold people back. So if we had these low rates, even if prices were to continue to go up, this would certainly alleviate the stress that many first-time home buyers are feeling out there in trying to afford a house and trying to afford a house payment and even rents. And it'll just definitely be interesting to see how this plays out. So anyway, sorry for kind of rambling on this time, but if you have any input, I'd love to hear your comments below. Let me know what you guys are thinking. Drop your 2 cents below. Let me know what your take on this is. And if you have any questions about anything, I'd love to talk and chat further. So as always, thanks for watching, guys. If you found value in this, please hit that like button. Make sure you subscribe. And if you think somebody else might find value in this, please go ahead and share this with them. I'll see you guys in the next video.